Hello friends, my name is Vishal Gurnani and today I'll be talking about one mistake that I believe 8 out of 10 investors are doing in the stock market, and I am sure you are one of them. Let me set the context first. Recently, a friend of mine shared his mutual fund portfolio with me and I saw that he has been doing an SIP of Rs 20,000 in the last 5 years. He was able to double his money in the last 5 years as we know that the markets have been going up. Now, one thing that I observed in his portfolio is that the funds that he is investing in are trying to replicate an index or an underlying asset. For example, Nifty 50, Bank Nifty, Small Cap 250 or Gold. If you are an investor who also has an active SIP in these kind of funds who are trying to replicate an index or an underlying asset, I would suggest that you should stop your SIPs. Let me give you a strategy which will help you make approx 2% extra returns on all your mutual funds investments. For people who think 2% is not a very big deal, let me give you an example which will tell you what a 2% extra return can do over a period of 20 years. Say for example, you do a SIP of 25,000 for 20 years, the extra returns which this 2% can generate comes to around 90 lakhs. This is the calculation that you can see on the screen. Now what is the strategy? The first step that you have to do is to identify that the mutual funds that you are investing in, are these mutual funds trying to replicate an index or an underlying asset? If yes, what you have to do is to see whether there are alternative ETFs available which are also trying to replicate the same index or an underlying asset. Say for example, you have invested in Nifty 50 mutual funds. In the market, there are ETFs which are also trying and replicating the Nifty 50 index. What you have to do is to do this exercise for all your mutual funds and add the relevant ETFs in your watch list. Once you do this, you have to invest in these ETFs on a daily basis. Suppose you were doing a 5,000 rupees SIP on each of these mutual funds, your total investment per month in mutual funds was rupees 20,000. On an average, there are 20 trading sessions in a month. This means you will have rupees 1,000 to invest every day in these ETFs. What you have to do is open the stock market daily whenever you have the time and see which is the ETF that has given the least return on that day amongst the 4 ETFs that you had identified. Invest 1,000 rupees daily and continue doing this. I am sure easily you will be able to generate an extra alpha of 1 to 2%. Let me give you 2 reasons why I am so sure that you will be able to generate an extra alpha of approx 2% as compared to a mutual fund investing. First, when you invest in mutual funds, there is an expense ratio which is charged by the fund house, and this is a straight saving when you invest via ETFs. The second reason is very important. If you do a SIP in the mutual funds, the units that are allocated to you on each SIP date is basis the previous day's closing NAV. This means you don't get the benefit of downward averaging. से सपोज आप मार्केट खोलते हैं एंड आपको दिखता है कि मार्केट अभी गिरा हुआ है एंड आप उस समय अगर कोई ETF में इन्वेस्ट करते हैं बट क्लोजिंग तक अगर वो मार्केट वापस रिकवर कर जाता है तो जो डाउनवर्ड एवरेजिंग का बेनिफिट आपको उस ETF बाय करने से हुआ वो आपको म्यूचुअल फंड में नहीं मिलता है, क्योंकि म्यूचुअल फंड हाउसेस आपको क्लोजिंग NAV के हिसाब से यूनिट्स अलोकेट करते हैं. If you follow my strategy, I am sure you will be able to generate extra 2% returns on all your mutual funds investments. And if you do this over a period of 20 years, आपने देखा कि कैसे आप 90 लाख से ज़्यादा का फायदा कर सकते हैं just by doing this simple strategy. If you like this video, please subscribe to my channel, stay tuned and thank you for watching.